Let me start with a number that sounds impossible. $92 trillion. That's not a typo. Not 92 billion. Not 9.2 trillion. $92 trillion. And here's what makes this terrifying. This isn't a stimulus bill. It's not a government budget. It's not a stock market value. It's a bet. A bet sitting quietly inside the financial system, spread across governments, banks, pension funds, insurance companies, and safe retirement portfolios. A bet so large, it makes the entire U.S. national debt look small. And if you've never heard of it, that's not an accident. That's the design. Because this bet isn't visible in your newsfeed. It doesn't show up in most headlines. It's buried in balance sheets, pension assumptions, and financial derivatives that almost nobody understands. But here's the key point. Every major global monetary era ended the same way, not with one dramatic crash, but with a hidden exposure growing too large to unwind, until one day something small breaks, and suddenly the entire system realizes it was built on a promise that cannot be kept. That's what this video is about. And by the end, you'll understand what the $92 trillion bet really is, why it exists, why it's growing, and how it could quietly reset the financial world again. Because this time, it doesn't just affect Wall Street. It affects your savings, your retirement, your job, your cost of living. Today, let's delve into the story of the $92 trillion bet nobody told you about. Do not forget to subscribe and like this video, as it's the best way to support this channel. When I say the $92 trillion bet, I'm not talking about one single contract. I'm talking about one shared assumption across the entire system. A belief, a mathematical story we've all been forced to accept. That governments can borrow forever, interest rates will always stay manageable, and inflation will always come back under control without breaking anything important. That story is the foundation beneath. Government debt bank balance sheets, pension promises, insurance guarantees, corporate refinancing, and the derivatives market that tries to manage the risk. Different institutions, different language, same bet. And here's the deadly part. It's not a bet that can be won. It's a bet that can only be rolled forward, delayed, refinanced, restructured, and disguised. Which means the only way it ends is when reality forces it to end. Let me simplify this in plain English. The $92 trillion bet is the combined exposure created by three forces. First, debt that must be refinanced at higher rates. Second, pensions and insurers that assume stable growth and predictable returns. Third, derivatives used to hide or shift the interest rate risk, but not remove it. The number itself can be debated depending on what you count. Some analysts focus on interest rate swaps and sovereign refinancing exposure. Others include unfunded obligations and implicit guarantees. But the point is the same. There is a massive hidden mountain of financial promises that only work if the world stays calm. And if the world doesn't stay calm, those promises start breaking. In slow motion, then all at once. Most people don't understand how government debt works. They imagine the U.S. borrows money and pays it off like a person pays off a loan. That's not what happens. The government rolls the debt, meaning when bonds mature, they issue new ones. It's refinancing forever. And this worked beautifully when interest rates were near zero. For years, the system was basically on cheat mode, but now rates are higher, and a massive amount of old, low-rate debt is maturing and being replaced with new high-rate debt, which means the cost of the debt rises even if the debt itself doesn't. That's how you get $1 trillion a year in interest. And once you reach that level, here's the problem. Interest becomes like a snowball rolling downhill. The government borrows more to pay interest. The borrowing increases debt. That debt increases interest, which requires more borrowing. That is the heart of the bet. And it's not just the US, it's global. Here's what they don't want you to think about. The US Treasury market is often called the safest market in the world. But the only reason it is safe is because the US can always pay in dollars. And the only reason the US can always pay in dollars is because dollars can be created. So the real safety isn't no risk. The real safety is you will be paid. But the value of what you're paid in may change. That's not default. That's a hidden form of default. It's default through purchasing power. And when the system leans too hard on that trick, history shows what happens next. Confidence begins to slip, slowly, then suddenly. Now let's talk about the part that hits ordinary people directly. Retirement. Most pensions assume a certain annual return, usually something like 6% to 8%. If they don't hit that return, they're short. But here's the catch. For years, pensions couldn't hit those returns safely. So they did what the system encouraged them to do. They reached for yield, they loaded up on risk assets, they increased leverage quietly, they moved into complex credit products. They bought safe bonds and hedged them using derivatives. They used financial engineering to create stability on paper. But stability on paper is not the same as stability in reality. And when rates rise fast, or inflation stays sticky, or markets get volatile, pensions are forced to rebalance at the worst time, which creates another kind of hidden bet. The bet that markets will always recover quickly enough before too many retirees draw down the money. That assumption has been true in some eras, but not in all, and it has never been tested in a world of this much debt. Insurance companies are similar. They sell long-term promises, life insurance, annuities, guaranteed payouts, and they back those promises with investments, often bonds. So when yields were low, insurance companies had a problem. They couldn't earn enough return safely. They had to either lower payouts and lose customers or take risk and hope nothing breaks. Guess which one they chose. Insurance firms became part of the global reach for yield machine. So now you have this situation. Rising rates help them eventually, but rising rates also crush the value of the bonds they already hold. And if they need liquidity during stress, they can be forced to sell at losses. That's how a stable institution becomes unstable. Not because it was reckless in public, but because the math cornered it in private. Now let's talk about the thing that truly creates system risk: derivatives. This is the part people either ignore or misunderstand. Derivatives are not inherently evil. They can be used responsibly. But in a highly leveraged system, derivatives become the invisible wiring. They don't remove risk, they spread it, which is good, until it's not. Interest rate derivatives, swaps, futures, options, sit underneath. Government bond markets, bank portfolios, pension hedges, corporate credit, mortgage securities, structured products. And the big reason they're used is simple: to manage interest rate exposure when rates move. But if rates move too much too fast, then the hedges require collateral, margin calls, liquidity drains. And suddenly, institutions that looked fine become desperate, not because they're insolvent, but because they can't meet cash demands. In modern finance, many collapses are not insolvency events first. They're liquidity events. That's why crises spread. Now, here's where history becomes important. Monetary eras don't end because people wake up one day and decide they hate the system. They end because the system accumulates hidden liabilities that it cannot honor under stress. Let me give you the pattern. In the late Roman era, the currency system was strained by military spending. The state debased coinage repeatedly. Confidence collapsed. In Spain's Empire era, massive war spending was financed by debt backed by future wealth. The wealth didn't arrive as expected. Defaults came in waves. In the Dutch era, financial sophistication expanded faster than the real economy's ability to support it. Hidden risks accumulated in the banking system. The structure cracked. In Britain's era, 2 world wars transformed the pound system into a debt-heavy promise. The empire could not sustain it. Capital moved elsewhere. The reserve status faded. Different centuries. Same mechanism? Overreach. Debt. Hidden exposures. Quiet capital flight. Then a reset. That is what ends monetary eras. Not one headline. 1,000 small fractures. Here's why the $92 trillion bet is so dangerous. Because it creates a time window, a countdown. When rates rise, it doesn't break the system instantly. What it does is increase pressure gradually across government budgets, refinancing cycles, bank funding costs, pension return gaps, insurer balance sheets, derivative collateral needs. And each month, each quarter, each year, the stress builds. Until a random event triggers the dominoes. That event could be a failed treasury auction, a sudden spike in yields, a major bank warning, a geopolitical shock, or a recession that collapses tax revenue. The trigger doesn't have to be huge. It just has to hit a system already at its limit. And this is the key. Highly leveraged systems don't break slowly, they break suddenly. That's why people are always shocked. They say, how did this happen overnight? It didn't. It happened invisibly for years.